welcome once again to Intelligent Investment Today. This is the podcast where we explore the enduring principles of intelligent investing, the ideas that help investors think clearly, act rationally, and build wealth over the long term. And today we're going to turn our attention to a book that sits slightly off the traditional value investment path, and yet in many ways complements it. A book that approaches investing not from the balance sheet, but from the business itself. The people, the strategy, the long-term potential. Today we're exploring Common Stocks and Uncommon Profits by Philip Fisher. Now this is not just any investing book. It is widely regarded as one of the most influential works ever written on growth investing. And importantly, it is also one of the favourite books of Warren Buffett. In fact, Buffett has often said that his own investment philosophy is a blend of the two approaches: the quantitative discipline of Benjamin Graham and the qualitative insight of Philip Fisher. So today we're going to explore what Fisher taught, how his ideas differ from and complement traditional value investing, and why understanding this book can take your investment thinking to a deeper level. So, as ever, sit back, strap in, and get ready to take on board another lesson in value investing as inspired by Benjamin Graham. To begin, it's important to understand what makes Fisher's approach distinct. Where Graham focused heavily on numbers, assets, earnings, valuation, Fisher focused on business quality. He was less concerned with what a company was worth today, and more concerned with what it could become over time. This is a subtle but powerful shift, because it changes the entire nature of analysis. Instead of asking, "Is this stock cheap?" Fisher asks, "Is this business exceptional?" And more importantly, can it continue to grow at a high rate for many years? This is a central idea behind Common Stocks and Uncommon Profits. That truly great businesses come not from buying average businesses at low prices, but from identifying outstanding businesses early and holding them for the long term. Now this may sound obvious. Of course, great businesses make great investments. But the challenge lies in identifying them. And this is where Fisher's contribution becomes particularly valuable. He developed a framework, often referred to as the scuttlebutt method, a way of gathering information that goes far beyond financial statements. He would speak to customers, to suppliers, to competitors, and employees. Indeed, anyone who could provide insight into how a company actually operates. Because Fisher believed that the most important information about a business is often not found in its published reports. It is found in its reputation, its culture, its relationships. And this brings us to one of the most important aspects of his philosophy: management quality. Unlike Graham, Fisher placed enormous emphasis on the ability, integrity, and long-term thinking of the management team. He thought that exceptional companies are often led by exceptional people. Leaders who are not only capable, but who are also focused on building enduring value. This, of course, stands in sharp contrast to Graham's more cautious view of management. Where Graham preferred not to rely too heavily on qualitative judgment, Fisher embraced it, but with a critical caveat. He did not rely on impressions. He relied on evidence gathered from multiple sources. He cross-checked information. He looked for consistency. He built a picture over time. This is an important distinction, because it highlights that qualitative investing is not about intuition alone. It is about informed judgment. Now, one of the most famous elements of Fisher's work is his list of 15 points, a set of criteria designed to identify outstanding businesses. We won't go through them one by one, but they centre around a few key themes: strong growth potential, high profit margins, effective research and development, a strong sales organisation, and crucially, a long-term orientation. Fisher was not interested in companies chasing short-term gains. He wanted businesses that were building for the future, that were reinvesting, that were expanding their capabilities, and that had the potential to compound value over many years. This idea of compounding is central to his philosophy, because when you find a truly exceptional business, one that can grow earnings consistently over time, the returns can be extraordinary, not because valuation changes, but because of the underlying growth of the business itself. And this is where Fisher's thinking begins to connect with value investing in a deeper way. Because while Graham focused on buying below intrinsic value, Fisher focused on growing intrinsic value. And the most powerful approach, as demonstrated by Warren Buffett, is to combine the two, to buy high-quality businesses at reasonable prices, and then hold them as they compound. This is of course summarised in Buffett's well-known phrase: "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." And that idea could sum up Fisher's approach. Now it's worth addressing a common misperception: that Fisher's approach is purely about growth, and therefore separate from value investing. In reality, the two are deeply connected, because value is not static. It is not just what a company owns today. It is what it can generate in the future. And growth is a key component of that. A company that can reinvest capital at high rates of return, that can expand its earnings year after year, will naturally increase its intrinsic value over time. So while Fisher may not have focused on traditional valuation metrics in the same way as Graham, he was still fundamentally concerned with value, just from a different angle. Now, of course, there are risks to this approach. Estimating future growth is inherently uncertain. It requires judgment. It involves assumptions about markets, competition, management execution. And when expectations are high, the margin for error can be small. This is where Graham's concept of margin of safety remains essential. Because even the best business can become a poor investment if purchased at too high a price. So the challenge for investors is balance. To appreciate quality without overpaying for it. To recognise growth without assuming it will continue indefinitely. And to remain grounded in valuation, even when the story is compelling. Another important lesson from Fisher is patience. He, like Graham, was not a frequent trader. He believed in holding investments for long periods, allowing the power of compounding to work. In fact, he famously suggested that the best time to sell a great company is almost never. Now, this does not mean holding blindly. It means recognising when the underlying thesis remains intact, when the business continues to perform, when management continues to execute. In such cases, the greatest risk is often not holding too long, but selling too early. And this is the lesson that many investors struggle the most with, because it requires resisting the urge to take quick profits, to react to short-term market movements, to constantly seek new opportunities. Instead, it requires a discipline, conviction, and a long-term mindset. Now, bringing this back to the broader theme of intelligent investing, what does common stocks and uncommon profits ultimately teach us? It teaches us to look beyond the numbers, to understand businesses as living, evolving entities, to consider management, culture, and strategy, to think in terms of years and decades rather than quarters. And perhaps most importantly, it teaches us that great investments are often found not in the obvious bargains, but in the exceptional businesses that can compound value over time. As we begin to draw this discussion to a close, it's worth reflecting on how Fisher's ideas fit within the broader framework of value investing. They do not replace Graham's principles, they complement them. Graham provides the discipline, the structure, the emphasis on value and risk. Fisher provides the insight, the understanding of quality, the focus on long-term growth. And together, they form a more complete approach. One that balances quantitative analysis with qualitative judgment. One that seeks both value and excellence. And one that recognises that investing is not just about what a company is worth today, but what it can become over time. And on that note, we bring this edition of Intelligent Investment Today to a close. I hope you found this exploration of Fisher's book, Common Stocks and Uncommon Profits, both insightful and thought-provoking, particularly in how it connects with the broader principles of value investing. If this episode has added something to your thinking, do add to playlist or subscribe so you don't miss future discussions. Do check out the new Substack newsletter at substack.com and by searching IIT Podcast. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.